Guys, if you're like me and you have a lot of your money in T-bills, CDs, or even cash, you may be wondering how that will be affected with all this talk of the debt ceiling and the government shutdown. Is all this talk between the Democrats and Republicans just fear-mongering and jockeying to get position to get the bills passed that they want? Or is there real risk here that maybe you're going to lose all your money on T-bills or CDs or even just the value of the cash that you hold? So let's cut through all the BS, see what's really going on, and talk about what could actually happen in a so-called worst case scenario. So you have these scary headlines with Yellen saying there are no good options if Congress fails to raise the debt ceiling. So Yellen saying that the failure of Congress to raise the $31.4 trillion debt limit would cause a huge hit to the U.S. economy and weaken the dollar as the world's reserve currency. And just so you know, the debt limit is a real number that we're not allowed to go above, although that number has been raised many times over the years. And when CNBC asked whether the U.S. Treasury could prioritize payouts to bondholders in the event of a default, Yellen said that Biden would be forced to make decisions on what to do with Treasury's resources if the debt ceiling was not raised, but declined to discuss or rank the options. So she's not saying that your T-bills will not get paid off or any of your government bonds or CDs, but what she is saying is that the only option that really leaves our economy in good shape and our financial system is raising the debt ceiling. Now, I guess that is what you would expect somebody to say whose main job is printing money. So Biden says that Congress has a constitutional duty to raise the debt ceiling. And of course, the Republicans are saying that they want sweeping budget cuts before they approve it, and the Democrats are opposing that. So they say risking default to secure budget cuts could bring enormous harm to American households, and that the dollar is regarded and Treasury securities as the bedrock safe asset in the entire global financial system. For now, it's trusted and it is the ultimate safe asset, and a failure to raise the debt ceiling, impairing the U.S. credit rating, would put that at risk. So that is a real concern. And so Yellen says Treasury will be likely unable to pay all the government's bills as early as June 1st without an increase in the federal debt limit. So that's about a month away, and that is already having an effect in the Treasury bill market. And so Yellen and other economists and analysts have repeatedly warned that a default on U.S. debt would result in millions of job losses while driving household payments on mortgages, auto loans, and credit cards higher. Yellen and the other economists did not say what would happen in the other case, that we raise the debt limit and spend into unlimited amounts of debt. What would that also do to job losses, payments on mortgages and auto loans and all of that? So it's a lot of fear mongering between Yellen and other economists that are on board and get paid from them to basically scare people into being for raising the debt limit. I don't want to lose my job. I don't want my mortgage payments to go up, blah, 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 all of that. It's not really clear how that will happen if the debt limit doesn't get raised. Unlike most other developed countries, the U.S. puts a hard limit. Now, you have to really laugh about this. The U.S. puts a hard limit on how much it can borrow. Because the government spends more than it takes in, lawmakers must periodically raise the debt ceiling. Really? How often is periodically? Let's see. Well, JP Morgan says that a technical default is a low probability event given the history of the debt ceiling, the so-called debt ceiling, which has been raised 78 times since 1960. Okay, 1960 is 63 years ago, and yet it's been raised 78 times. So what kind of debt limit is that that is raised an average of more than once every year since 1960? Now, default risk is a real thing, and this is the 1-year US sovereign risk credit default swaps. And you see Lehman Brothers, they shot up here. US debt downgrade in 2011 shot up to about 75. Government shutdown, debt ceiling crisis 2013, around the same. But here we are now at 177. So a lot of people are taking this seriously. And so because of that, the Treasury bill yields that mature around the time of June have spiked a whole bunch compared to the rest of the Treasury bill curve. And so JP Morgan says there have been 3 major credit events for US debt: 2011 debt downgrade, 2013 debt downgrade, and 2014 debt upgrade. And so the 2011 downgrade occurred in August, triggering a 4.8% decline in the S&P 500, and the VIX spiked from around 20 to 31 on August 4th, peaking at 48 on August 8th. And the 10-year Treasury yield fell from 2.74 to 2.11 on August 10th, and hitting a 52-week low by September 22nd at 1.72. So JP Morgan says if you think things will play out similar to 2011, you can play it by shorting the S&P 500, which fell more than 15% on a 3-month basis, buying bonds because the 10-year fell as much as 75 basis points, and buying gold, which rallied more than 15%, and buying the US dollar, which rallied about 5%. And so here are the 1-month returns from August 2011 when we had the debt downgrade. S&P minus about 7 points, NASDAQ minus about 6, gold up 13%, dollar index up 1%, 20-year bond ETF TLT up 10.6%, and financials down 13%. So let's take a look at the difference between treasuries and CDs and corporate bonds. So the 3-month or less treasuries are yielding 5.2% because a lot of these have been sold off because not a lot of people want to hold them when they are maturing around June during the whole debt ceiling crisis. There's a lot of uncertainty here, so a lot of people have sold these. And it looks like a lot of that money went into corporate short-term debt because that's only yielding 3.18%. So they sold a lot of treasury bills and bought a lot of corporate bills, it looks like. So if you believe this whole debt ceiling debacle is going to blow over and they're going to raise the debt limit like they have the last 78 times, you might want to buy some short-term treasury bills. They're yielding really well right now, 5.24 or so. 6 months, 5.1, even 9 months, almost 5%. And so if you want to invest a year or less, CDs look about the same as treasury bills right now, but going out farther than 2 years, there's a big difference, right? 5.1% versus 4.11%, 10-year 4.85 versus 3.53. And let's see these banks giving 4.85. There's not a lot of them, and it's only 3 of them that are really up there. The rest are 3.7, 3.6. 5-year CDs are paying 5% or very close to it, so that is not a bad option. So we see that the debt limit problem is a real thing, and there are some market participants that really are selling off their treasury bills and putting it into other things, maybe short-term corporate bonds or something like that. But that's mostly for the stuff that is maturing right around June. So they don't want to have that uncertainty of what's going to happen when their bills are maturing, if their money is going to be delayed or something along those lines. So what could really happen if they do default on the debt and don't raise the debt ceiling in time is this. If you say have a T-bill that matures around June, you may not get your money back. And that doesn't mean it goes away forever. It means it is delayed. And so it's not going to be delayed for 5 years or anything like that, but it may be delayed for 2 days, 2 weeks, something like that, because there will be so much pressure to raise the debt limit. It will eventually happen. They're just doing kind of a game of brinkmanship right now. It's almost like you are in an episode of professional wrestling and they're both playing their scripts, the bad guy and the good guy and all of that. So yes, there is a real risk that you will delay getting your principal back on T-bills or even bonds or bond interest that are coming due in June or anything like that. That is a real risk. If you need that money or you depend on that interest or principal to do something, then you would move your money out into something that doesn't carry that risk, like maybe a CD or just cash. But it's not going to be like, oh, well, debt limit not raised. Those T-bills you got are now worth zero and you lose all your money. That's not going to happen. If that did happen, everything else would go down with it, including the dollar, the economy. All of those Congress people would lose their seats and they would lose their money as well. And they have a lot more money than you do. So don't be fooled. They don't want to see their money get destroyed either. Now, as for CDs that are coming due, that is a different thing. And the banks should have the money whether the debt default happens or not. The only other problem I could think of is if there are more bank runs and banks blow up and they need to bail out banks above what the FDIC has in their insurance fund, and they need to go to the government, and the government is shut down with their whole debt default thing and not raising the debt limits, then that could be a problem. But that is something that has probably a low probability. But the bottom line is that they are already worried about countries getting rid of dollars. So when countries hold cash, they don't actually hold dollar bills. They hold Treasury bills and Treasury bonds because they get interest from it. They don't actually hold physical cash or not a lot of it. So a debt default and delay of payment of interest to Treasury bill holders in the US and in other countries would be even worse for the dollar right now, or anytime really. So I would not worry too much if you are holding Treasury bills, Treasury bonds, CDs, anything like that, unless you need those specific payments right around the June timeframe. Then it's possible it will get delayed a little bit. I expect that this is all talk and they will come to a last minute deal at midnight or something along those lines to try to make themselves both look good. And in terms of the difference between T-bills, money in the bank in CDs, and cash under your mattress, it's kind of like this. The T-bill is supposed to be the risk-free return, meaning they are the least risky of any security in the world. So think of the T-bills. If they were in a plane, they'd be riding at the front of the plane in first class. And maybe bank deposits, bank CDs, they are flying business class because they have the FDIC insurance, even though FDI insurance only insures about 1.25 cents out of every dollar in deposits in the US. That's how much they have in their insurance fund. And then flying in the back in coach is your actual physical dollars and their value on the world market currently, right? If the debt default happens, it's like that plane crashing. So yeah, the T-bills are gonna die first because they're in first class. And then a split second later, the bank deposits are also gonna die because they are right behind first class. And then another split second after that, the people in coach are also gonna go up in flames and the value of the dollar will crash as well. It will be one big domino effect that will happen very quickly. And they all realize this. And like I said, the people that matter are a lot richer than you, and they don't want to see their money go up in flames either. By the way, Warren Buffett has approximately $100 billion in T-bills. So I'm pretty sure if there was a real risk of something bad happening, he would call up the people that he has a lot of influence with, as well as a lot of other really rich people that have a lot more to lose than you. So I wouldn't worry about it too much. If you have T-bills, hold on to them. If you're thinking of buying some T-bills, maybe buy some right around that time, 1 or 2 months. They pay a little bit better interest because of that, or just stick with CDs that are also paying pretty good rates right now. I hope you like this one. I'll see you in the next one, guys. Thanks for watching.